Silver is down 25% from its 2026 high. At the same time, Shanghai is paying $11 more per ounce for physical silver than the Western paper price. Both of those facts are true simultaneously, right now, today. Those two realities cannot point in opposite directions forever. One of them is wrong, and the physical market has a perfect track record of being right. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Silver spot XAG USD is at $67.79. Shanghai physical is at $79. The vault drain is accelerating. First notice day is 7 business days away. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today: the Shanghai Gold Exchange. The AG T+D contract, and which requires physical delivery settled in real metal, is printing at approximately $78 to $79 per ounce as of this weekend. COMEX front-month silver futures closed Friday at $69.66. That is the lowest close since December 2025. XAG USD spot on Sunday is at $67.79. The intraday range today alone runs from $67.52 to $74.58. That is a $7 range on a Sunday, with no futures market open to provide liquidity or price discovery. The divergence between Shanghai and COMEX is $11. That is 12 to 16%, paid by real buyers, for real metal, with real delivery obligations. This follows a period where silver surged over 135% in 2025 and is now giving back 25% in a matter of weeks. The unusual detail is not the decline. Declines happen. The unusual detail is that the decline is happening while the world's largest physical silver market is paying a double-digit premium above the Western price, the divergence. Think about what that sequence actually means. When paper price falls while physical premium rises, that is not a market in agreement. That is a market at war with itself. The ones paying attention already know which side of that war has never lost. Before I show you the full vault picture, consider this. The last time COMEX registered silver dropped by 1/3 over 6 months, it was 2020. Silver was under $20. Within 18 months, it was above $29. The registered base today started from a higher level. The direction of the drain is identical. The data is already telling you something. Let's build it out. Now let's build the full picture, because the Shanghai divergence does not exist in a vacuum. CME Group COMEX daily warehouse reports show registered silver, the only metal eligible for delivery against open contracts, at 103 million ounces. That number is down 1/3 from the September 2025 peak. 1/3 in 6 months, one direction. The CFTC Commitments of Traders report shows total open interest on COMEX silver at 429 million ounces of paper claims outstanding. That is a coverage ratio of 24%, one deliverable ounce backing every 4 paper ounces claimed. The April 2026 COMEX silver contract enters first notice day in approximately 7 business days. Per CME Group contract data, approximately 1,127 contracts, representing 9.6 million ounces, remain open as of Friday's close. Those contracts either roll or stand for delivery. If even a fraction stand, 9.6 million ounces of demand hits a 103 million ounce registered base that has already shed 1/3 of its peak. Meanwhile, the Shanghai Gold Exchange AG T+D contract settles in physical metal. Chinese solar manufacturers, the single largest industrial consumer of silver globally, are paying $79 per ounce because they cannot roll a contract. They need the metal to build panels. EV battery producers need it. Electronics manufacturers need it. The rate of registered stock withdrawal is not stabilizing, it is compounding. The ones who have been called alarmist for pointing at a 24% coverage ratio, they are not saying much right now. And here is what makes that picture even harder to ignore. 429 million ounces of paper claims exist against 103 million ounces of registered physical. That is the tension. At the same time, the paper price at $67.79 is $11 below what physical buyers in Shanghai are paying right now. That is not a contradiction. That is the setup. Paper sellers in Western markets are driving the COMEX price lower. Physical buyers in Eastern markets are refusing to follow. Those two forces are pulling the same market in opposite directions, and before anyone takes that structural picture as a green light to act, Setups can take weeks or months to resolve. The first notice date creates a mechanical pressure point, but delivery demand is unpredictable. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about. $110. That is where crude oil is trading right now, per barrel, because of the Iran conflict. And that single number is the reason silver, despite everything the physical market is signaling, has not yet rebounded. Now the macro variable, because this is no longer a backdrop, it is the primary variable. The Iran conflict is in its third week. Oil above $110 per barrel feeds directly into global inflation expectations. The Federal Reserve, per its March 18th Summary of Economic Projections published at federalreserve.gov, held rates unchanged and shifted its median dot to one cut in 2026, with a growing minority projecting 0 cuts. The U.S. 10-year Treasury yield, tracked daily at the U.S. Treasury Department website, sits at 4.37%, its highest since July 2025. The ICE U.S. dollar index DXY trades near 99, up nearly 2% since the Iran conflict began. That dollar gain has been sustained for 3 weeks. War-driven dollar strength typically fades in days. This has not faded. Markets are still pricing some residual probability of a 2026 rate cut. Look at a 10-year yield at 4.37% and a Fed dot plot with a growing zero-cut minority, and tell me what probability you honestly put on that. When markets fully price the reality of what those projections are communicating, silver faces continued paper selling pressure, gold faces continued paper selling pressure. That is the historical pattern. Every time a hawkish Fed pivot has combined with an energy inflation shock, precious metals have faced short-term financial headwinds before recovering. It has not been different yet. Silver Western Spot at 67.79, intraday low today at 67.52, Shanghai Gold Exchange Ag T plus D Physical at approximately $79. That is the $11 premium. The short-term picture is this. If the DXY holds above 99 and the 10-year yield holds above 4.20%, paper selling pressure on COMEX persists. The $11 Shanghai premium remains a structural tension, but not an immediate price trigger. If oil drops meaningfully below $100 per barrel, rate cut expectations revive, the dollar weakens, real yields soften, and silver has the conditions for a violent recovery toward $80 to $85. That is the only short-term read that matters. As for trading the lower time frames right now, the data does not show a clean picture. Silver moved more than $5 on a Sunday with no futures market open. That is not a tradable environment for most participants. I cannot tell you what silver does at Monday's open. Nobody can. If you think you can, good for you. The tape has been ruthless on both directions this month. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. 1. The DXY at 99 and the 10-year Treasury yield at 4.37% represent maximum financial headwind for a zero-yield metal in a hawkish Fed environment. 2. Silver carries industrial demand exposure, and $110 oil creates a global growth slowdown risk that softens solar, EV, and electronics demand simultaneously. The exact industries driving physical consumption. 3. The SGE premium could compress if Chinese industrial activity slows under global energy cost pressure, removing the physical floor that currently contrasts with COMEX. The bull case is equally real. 1. COMEX registered silver stands at 103 million ounces against 429 million ounces in open interest, a 24% coverage ratio declining for 6 consecutive months per CME Group warehouse data. 2. Shanghai Gold Exchange physical silver at $79 versus COMEX at $67.79 is an $11 premium paid by real industrial buyers who cannot substitute away from silver in solar, EV, and electronics manufacturing. 3. April 2026. First notice day arrives in 7 business days with 9.6 million ounces in potentially deliverable contracts against a registered base that has already shed 1/3 of its September 2025 peak. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Silver is down 25% on paper. It is up $11 in physical. Those two numbers live in the same market. That gap is the entire story. The only question is which number moves to close it. And the physical market has never been the one to blink first. Don't take my word for it. Verify every number given today. Check the data yourself. CME Group COMEX warehouse reports at cmegroup.com. CFTC commitments of traders at cftc.gov. Shanghai Gold Exchange at sge.com.cn. Federal Reserve plot projections at federalreserve.gov. Logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. Drop OG John AG in the comments right now if you are here paying attention and actually learning. OG John AG 1.0, out.